Welcome traders, this is Maciej from Taurus Trading, and in today's video you will learn how to set your stop loss order. So let's get started. First, let's talk about what is stop loss order. Stop loss order is a tool used by traders and investors to limit losses and reduce risk exposure. With a stop loss order, an investor enters an order to exit a trading position that he holds if the price of his investments moves to a certain level that represents a specified amount of loss in the trade. By using a stop loss order, a trader limits his risk in the trade to set an amount in the event that the market moves against him. There are several types of stop loss orders, and I will focus mainly on the most popular ones. First one is a fixed, so-called money management stop loss. Second one is price action based on the market structure. And the third one, which is dedicated to the most advanced traders, it's a mental discretionary stop loss order. Fixed stop loss order is based on volatility. So basically you're taking into consideration average range of the instrument that you're trading. Let's for example say you're trading a stock, so you're looking, depends on the time frame of your choice, you will be looking at an average range of the stock. So for example, how much does the stock moves on average each day or each hour, depends on the time frame of your choice. An indicator to use by many professionals to set stop loss based on volatility is called average true range, and is always accessible to all of the trading platforms. You can take a look at the TradingView, for example, which is a free platform for traders to get an idea how an average true range works. And the other type of fixed stop loss is calculated from percentage change, and this is basically applicable to stocks or commodities or maybe some cryptocurrencies. And surprisingly, it has almost the same advantages as the volatility-based stop loss. There is a great research made by Cesar Alvarez. I believe he's got a video about this on the YouTube, so you can do your research by typing Cesar Alvarez stop loss, and he's comparing volatility-based stop loss to the other one, which is calculated from percentage change, and basically results are pretty much the same. However, stop loss calculated from the percentage change is not very good idea if you're trading Forex, since Forex, these are two different currency pairs which are stacked against each other, and in this way they forming a Forex pair, so you won't be able to use stop loss calculated on the percentage change. The other type of stop loss is based on price action or market structure. So if let's say the stock or Forex pair that you're looking at is in an uptrend and you want to buy into this uptrend, you will be placing a stop loss order below the recent low. And the opposite is true if, let's say, you're looking at the price of oil or corn and it's in a clear downtrend and you want to take a short position, then you will be looking at the market structure and you will be placing a stop loss order just above the recent high to protect your capital. Also within price action stop loss order, there is a order based on the size of the bar, and the difference between this type of order and the one that I was talking about a minute ago is basically that you're taking a size of the bar, which is your entry bar, and if let's say that we're using this example of an uptrend and you're buying into the uptrend, you will be placing a stop loss order below the low of the bar, which is your entry bar. So basically your risk is smaller comparing to the stop loss that I've mentioned previously, because if you take into consideration a recent swing, usually it's a couple or 3 or 4 times bigger than the size of the recent bar. So you're risking more if you're using a stop loss order based on the recent swing. There is also a mental stop loss order, which is also called discretionary stop loss order, and this is only for very advanced professional traders who are not using any leverage, and usually they are buying stocks like let's say Warren Buffett does. So I'm pretty sure that he's not using any of the stop loss orders that I've described before. He will just exit his position whenever he decides that the stock he purchased is no longer a good value for his Berkshire Hathaway company. So this way he's using a mental stop loss order. He probably already know the price level where he wants to exit, more or less, but he's not doing this automatically, I believe so. He will just exit on the very day that he will decide to sell the stock. If you are using a very tight stop loss order, there are of course some pros and cons of this type of approach. So let me touch upon this subject very briefly. So pros of using a very tight stop loss are better risk to reward ratio. So as I've mentioned already, if your stop loss is very tight and your risk is very small, then potential reward is greater. So what I mean by that, let's say that you are using a stop loss based on the size of your entry bar. So like I said, this will be a pretty small risk comparing to potential reward, especially if you are buying stocks. Your risk is very little comparing to the upside, which is basically unlimited. So this is very good approach if you want to have a so-called a positively skewed strategy, which means that over a long period of time there is no way that you can lose money with this type of approach. Also, if you are using a very tight stop loss, you have an ability to use more leverage, so you can have a bigger position, unlike if your stop is wider. If you're using a stop loss based on average size of the recent bar, it will be comparably smaller than the stop loss based on the recent swing, and this way you can apply more leverage. So coming back to the example of stocks, you can just buy more shares of the stock, unlike if you're using a wider stop. Of course, there are some cons of using a tight stop loss, and the first one will be the psychological one, which means that you will be losing many more positions than if you will be using a wider stop, simply because a tight stop loss tend to be hit more often than the wider stop. So you need to be prepared mentally to have a losing streak of maybe 20 or 40 or maybe even more times. And also this type of approach requires an appropriate position size. For that very reason, if you will be experiencing a long losing streak, you cannot have a position of the size of, let's say, 5% of your total capital, because it only takes a losing streak of 20 trades to wipe your account out. So especially if you are day trading, you should be using a stop loss at all times, since it involves a lot of leverage and you don't want to have your account wiped out in a matter of minutes. and it's widely accepted that the narrower a time frame a trader works in, the more risk they are likely to be exposed to, meaning that day trading is one of the most riskiest approaches to the financial markets. Mistakes are more costly and they have the potential to occur more frequently since the act of trading itself is occurring more frequently. So I've prepared a few examples of type of stop losses that I've mentioned previously. And the first one is a price action stop loss order set by using a current market structure. So as you can see, if you are buying to the uptrend, you will be placing your stop loss order just below the recent low, and like I've mentioned, it's usually a few times more you will have to risk than if you will be placing your stop loss below the low of the entry bar. So this is an example of using a stop loss order based on the size of the recent bar. This will be your entry bar. So if you are buying into this uptrend, you will be simply putting a stop loss order just somewhere below the low of the bar, but of course depends on what type of instrument you're trading, and if your broker is providing a quite a huge spread, you need to take this into consideration and add this to your stop loss as well. The third example I've prepared is a stop loss based on average true range, as the indicator I've already mentioned is widely available on all trading platforms. This is the solid black line on the very bottom of the chart, which tells you the value of the average bar. I believe the default setting is 14 bars. However, I tend to use a bigger number to get more stable result. So usually I will use 100 instead of 14. And this is pretty useful, especially if your entry bar is way bigger comparing to the other bars, so you don't have to risk a lot. And like I said already, it's very appropriate when you considering risk to reward ratio. So I hope you've enjoyed this short video. I'm planning to, of course, prepare many more educational materials like this, so you can consider subscribing. Also, I will put a link in the description of this video which will direct you to my website, where you can grab your free copy of the ebook that I've prepared, which is packed full of information about financial markets, which I'm sure will be very useful for beginners on their journey to financial freedom. Of course, feel free to ask as many questions as you like in the comment section, and I will try to do my best to answer to all of them. So thanks for watching today's video, and like I said, consider subscribing to my channel so you won't miss any new videos that are already in the works, and I will see you next time.